Hey there, Brad Castor from GreatOptionTradingStrategies.com. I know it can sometimes seem like this, but the stock market doesn't have to feel like you're lost and wandering around a dark alley and just praying that you don't get mugged, or worse. That's why I sell options, because the stock market should actually be fun and consistently profitable. Now, it doesn't always work out this way, but when I'm in that flow state, selling options really feels like a game. I call it Wall Street Tycoon, and I sort of see it as a combination of poker, chess, and your favorite board game from the 1970s. And why is it so fun? Because it's strategy-based. It's pretty easy once you really understand how to play it and what your advantages are. And of course, you can make a lot of money playing it. Also, it's almost always heads I win, tails Mr. Market loses. And today I want to walk you through an official leveraged investing club trade we closed out last week to show you exactly what I'm talking about. This is a put selling mini campaign on SNDK. I've been covering this trade in my last two videos, and I've added links in the description for you to check those videos out. The final book returns were $1,103.16 or a 61.95% annualized ROI over a 13-day holding period. But this video isn't just a victory lap. I want us to look at the trade in the context of that strategy game analogy to show why the trade made so much sense in terms of strategy, common sense, psychology, etc. This did not require complex analytical skills, rigorous fundamental analysis, poring over financial documents, or any second guessing or hand wringing. A Monopoly playing 13-year-old could have made this trade. Seriously, trading, investing, it doesn't have to be difficult or stressful. Again, it should be fun and easy and lucrative. Gain clarity, understand the rules of the game, and if you play a superior strategy, winning isn't a matter of luck. It's inevitable. So I'm going to divide this mini campaign into three parts: the setup, the play, and then the end game. Now, it was originally a 1-week trade that I extended to a second week. So when I say mini campaign, I do mean mini. The SNDK trade was also part of a category of option selling trades I call big mover trades. I've covered this category of trade in the past and have only grown to love these trades even more over time. A big mover opportunity occurs when a stock makes a big move in one direction or the other, and you deem it highly unlikely that the stock will reverse that move fully and be trading back where it had been trading before the big move, and by the end of the current week, or at the very latest, the end of the following week. And the payout also has to be worth your while. Now, I've also added some big mover resources in the description section. That includes the links to a couple of videos, one of which is a full tutorial, and another one that's a case study detailing a successful big mover trade on Oklo. And if you haven't done so already, check out the Big Mover downloadable special report with all the details, plus even more examples in which you can view, print, or download. That report is available on the Great Option Trading Strategies downloadable library page. Everything there is free, of course, so help yourself to any or all of the resources you find there. Okay, so let's play a little Wall Street Tycoon and dive into the SNDK trade. Part 1, the setup. Okay, so let's recap the situation and setup here. SNDK reported earnings back on Thursday, January 29th after the market closed and just crushed it, and also projected very strong growth ahead. They reported blowout earnings, blowout margin expansion, and strong forward guidance tied to real demand in memory driven by the AI infrastructure build-out. Prior to the earnings release, the stock was trading right around $540 a share. And below that, I identified $500 as a likely new key support level, which had previously functioned as resistance that SNDK did finally break through to the upside in the days leading up to the earnings release. So we could have sold puts at that $540 level, the big mover level, but I chose to play things more conservatively by going to that lower secondary key support level at 500. And believe me, the payout there was still very nice. But it just wasn't the technicals or the big mover aspect that attracted me to this setup. Because of the massive increase in anticipated earnings, the forward PE if the stock fell below $500 would have been in single-digit land. Additionally, and you always have to take analyst upgrades and downgrades with a big grain of salt, but analysts were falling all over each other, raising price targets. Raymond James raised their price target to $725, Goldman Sachs raised theirs to $700, Bank of America raised theirs to $850, and Bernstein raised theirs all the way to $1,000 a share. So with the shares around $592, we sold the $500 put 1 week out and collected $5.80 in premium. That worked out roughly to be a 60% annualized return on a cash secured basis projected over 7 days until expiration. Now here's the part that made it so obvious. For the trade to get into real trouble, the stock would have had to not only give back the entire post-earnings move, but also break back below its pre-earnings level and then violate that freshly established $500 support level. And it would have had to do all that very quickly, in only a week in fact. That's a whole lot of unlikeliness and not much time left on the game clock. Part 2, the gameplay. At one point during that first weekly leg, after hitting an intraday high at $725 a share, SanDisk started giving back some of those gains. And with the stock pulling back to $664.98 a share, I saw that there was an opportunity to roll my February 6th $500 short put out one more week to the February 13th expiration cycle for a really nice $5.45 per contract net credit. That was a little less than the $5.80 of premium I collected from selling the original $500 put, but it was in the ballpark. And I still felt very comfortable with the $500 strike price. Now, as you can see in this chart, the volatility did continue in SanDisk shares, but surprise, surprise, that $500 short put position was never in any danger. But that $540 level, the big mover level, or where the stock had been trading prior to the big move, was challenged a bit on Tuesday of the second week. And not really a surprise there either, it held. But what if the unthinkable and totally unrealistic had happened? What if SanDisk did in fact fully reverse the big move and trade back below $500 a share on us? That's where the tails Mr. Market loses aspect comes into play. With SanDisk option premium levels being as insanely high as they were, I have zero doubt we could have rolled our $500 short puts down and out to a lower strike, and as many times as we needed to, and likely only 1 or 2 weeks out at a time, and continue collecting more net premium and keep getting paid to wait for the stock of a fundamentally strong company to, at the very least, just stabilize. And this is something I've learned over 25 years of selling puts and covered calls for income. The hardest trades to repair are often the so-called safe names with low implied volatility levels because the premium just isn't there. In volatile names with fat premiums, you have more room to maneuver and more income to offset mistakes. Premium in many ways is your shock absorber. So even if it had happened, the implied volatility on SanDisk options was still elevated enough that rolling down and out for continued net premium would have been very manageable. That's something sometimes people underestimate. Elevated implied volatility isn't just a signal of risk. It's also a gift to the option seller because it gives you immense flexibility to manage and repair trade and get things back on track. So with SanDisk, worst case scenario, but implied volatility option pricing likely would have remained very elevated and the campaign might have turned into a multi-week process instead of 13 days, but it still would have been highly manageable and highly profitable. Part 3, the end game. So theoretically, last week we could have done what we did the week before. Extend the trade again by rolling the $500 short put out another week for another fat net premium payout. Except the net premium available for week number 3 wasn't nearly as fat as it had been for weeks number 1 and 2. And the original big mover thesis that Mr. Market couldn't fully reverse the post-earnings big move in a short time frame would have been less intact the more time we added to the trade. Now, it may have been virtually impossible for Mr. Market to push SanDisk back below $500 a share within a week, but the more time we give him, the less impossible it becomes. And as we saw in week number 2, Mr. Market did make a move back to the 540 big mover level, which held, of course, but there's no guarantee it holds forever. And the decision to walk away after only a couple weeks of the campaign harkens back to what inside the Leveraged Investing Club I call our mission statement with teeth: to sell as much time value as possible, as efficiently as possible, and as safely as possible. Efficiency and safety are opposite impulses. One is about greed, the other is about fear. Left unchecked, each is a terrible way to approach the market. But when used together, or to counterbalance the other, it's a match made in heaven and a recipe for safe, sustainable, high-yield income. So we let the trade run until this last Thursday when we were able to exit a day ahead of expiration on the cheap, and we bought to close the position for just 20 cents a contract. Final returns, $1,103.16, or more than half of the one-time fee to join the Leveraged Investing Club as a permanent lifetime member for a 61.95% annualized ROI over 13 days. Okay, there you go. This is what I mean when I say option selling should feel like a game, and it should be fun. Not a slot machine, not a coin flip, at least not one where you have to flip heads or else you lose. And thanks but no thanks, but I don't need an adrenaline rush every time I trade. I much prefer playing a rigged game where you understand the rules, you understand your advantages, and you wait for favorable setups instead of forcing trades and hoping for the best. Not every week will hand you something this clean, but opportunities like this show up again and again for traders who are patient and who are willing to think strategically instead of emotionally. If you want to see more campaigns like this, entered, managed, adjusted, and exited, sometimes even in real time, make sure you subscribe to the Daily Option Tips and Insights newsletter, or download one of the many resources from the Grid Option Trading Strategies library page. That's also the only path to eventually receive an invitation to join the Leveraged Investing Club. The market doesn't have to be chaotic, and you don't have to approach it chaotically. Sometimes it really is this straightforward. Until next time.